BigBear.ai stock has been one of the hottest stocks in the market this year, as investors are enthusiastic that this company can achieve the kind of success that Palantir has achieved in recent years. And investors are asking me, what do I think about BigBear.ai stock in terms if it's overvalued or undervalued, and if I think it's a buy, hold, or sell at current market prices? So I'll answer those questions in this video, so let's get right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
Right, so one of the things I wanted to look at with BigBear.ai is the revenue growth in recent years. If it's going to achieve the kind of success that Palantir has achieved, it's got to demonstrate revenue growth so that investors can get more enthusiastic that the company's products and services are increasing in demand. But we're not really seeing that with BigBear.ai, despite the fact that the company has even made acquisitions to help support and increase revenue as a result of an acquisition, not as a result of organic increases in demand. So its revenue in the most recent trailing 12-month period at 153 million is down from 158 million last year and is down from 155 million since 2022. So since 2022, over the previous 3 years or so, the company's revenue is actually down, despite the fact that it's actually even made an acquisition in those recent years. So that's not very encouraging for investors in BigBear.ai stock, but the company has signed new deals and recent contracts, and the current administration in the United States increasingly concerned about securing the borders. BigBear.ai's technology at airports is a strong beneficiary of that immigration policy by the current administration. So that had led to an enthusiasm from investors, hoping that the increase in immigration enforcement and the increase in restrictions of immigration could help increase demand for BigBear.ai. But in the company's most recently completed earnings report and earnings call with Wall Street analysts, the company actually said that the policies of the current administration actually caused the company some headwinds because of the cost cutting and the reductions in government spending that led to the company losing some contracts and some contracts being delayed. So it hasn't been all great news for BigBear.ai. So the next thing I wanted to emphasize is the company's return on invested capital. Now, I don't mind investing in companies that have negative returns on invested capital, especially early stage growth companies that are still in very early stages of development. So negative ROIC is okay. But I like to see progress towards improvement, and that's been something that BigBear.ai had been demonstrating very aggressively, improving from negative 28% in 2021 up to negative 12% in 2024. So it had been making very nice improvements in recent years before turning things around and turning back negative in the most recent trailing 12-month period at 15.3% negative. Furthermore, I expect this might worsen further still, because remember, in the most recent conference call with Wall Street analysts, the management team told investors that they will be investing aggressively to try and capture and re-accelerate revenue growth, which was disappointing in the most recent quarter and in recent years. As I shared with you in the previous slide, the company hasn't really grown revenue in 3 years. And so the management team is now saying they will invest more money, more capital to try and accelerate revenue growth, which may or may not work, but the returns on invested capital are likely to continue worsening because this is an aggressive stance. This isn't like a management team saying, we want to grow, but we want to grow efficiently and effectively. That's not what the management team is talking about. They really want to accelerate revenue growth, and they're willing to suffer more losses in profitability and inefficiency to capture that growth, is what I'm getting in the messaging from the management team. They've already made an acquisition in the past, and they're open to more acquisitions in the future. And acquisitions are usually a situation where companies do not generate sufficient returns on the acquisition. A lot of times the synergies and the benefits are overestimated, and companies end up overpaying for acquisitions. Relatively few companies, and I'll highlight Broadcom as one specific example of a company that's made prudent acquisitions. Many others, like Salesforce, often end up paying too much for the companies they acquire. So now that we looked at performance metrics, let me share with you my fair value calculation for BigBear.ai, which is going to disappoint a lot of you BigBear.ai enthusiasts. And I know it's a popular stock among retail investors because it trades at less than $10 per share, because it's an AI stock, because Palantir is so successful. You all are very excited about this company potentially achieving the kind of explosive share price gains that Palantir has achieved, and that might still be the case. However, I don't see that as being very likely anytime soon. The fair value of this stock I calculated is only $1.31, while the market price is $7.52. So it's trading at what I believe is a significant overvaluation at the current market price. So what I'm seeing with BigBear.ai is a stock with a lot of potential in the future, but a lot of difficulties to overcome. Additionally, business models that are not generating accelerating growth, with the management team looking to invest to generate that acceleration in revenue growth because they don't feel like they have the assets in place to generate revenue growth as the business stands today. So we're dealing with a business with elevated risks, trading at an overvaluation with already a great deal of investor enthusiasm, right? It's not an underestimated stock. It's not one of those stocks that's not loved by the market. It's actually very much loved by the market, very much loved by retail investors, and that's why you see a very high valuation for something that is already highly regarded by many investors. So it's not a situation that I find attractive as an investor. And so I'm rating this company as a hold, and I updated that recommendation on October 10th, 2025. This doesn't mean that the stock can't explode. Maybe it will, maybe it won't. I just don't like the risk versus reward at the current market prices.
Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.